What if you could own a piece of a gold mine without ever touching a shovel? Or earn money from every pizza in Canada without flipping a single pizza? That is the royalty business model. Today I am breaking down exactly how it works, why investors love it, how it compares to REITs, and which Canadian royalty stocks are worth your attention in 2026. So what is a royalty exactly? In simple terms, a royalty company owns rights to an asset, a mineral deposit, an oil well, a brand name, or a patent, and instead of operating that asset themselves, they let someone else do the heavy lifting. In exchange, they collect a percentage of revenue or production. No drilling. No mining. No flipping burgers. Just collecting a check. The genius is in what the royalty company does not do. It does not hire workers. It does not buy equipment. It does not deal with cost overruns or environmental cleanups. All of that is the operator's problem. The royalty holder just takes their cut. Here is how the flow works in practice. First, the royalty company acquires the rights to an asset. Second, an operator does all the actual work. Third, the operator pays a percentage of revenue or production back to the royalty holder. And fourth, the royalty company distributes most of that cash to its shareholders as dividends. It is a beautifully simple model when it works well. Royalties are not just a mining thing. There are four major types on the Canadian market. First, precious metals royalty and streaming, companies that finance gold and silver mines in exchange for a cut of production. Second, oil and gas royalty, companies that own mineral rights and collect a percentage of what is pumped out of the ground. Third, brand and franchise royalty, think fast food chains paying a fee to use a trademark. And fourth, diversified royalty, companies that hold a basket of unrelated royalty streams across different industries. Now that we know what a royalty company is, let us talk about why investors love them, and where things can go wrong. There are 5 key reasons the royalty model is so popular with income investors. First, it is asset light, there is no massive capital spending. Second, margins are incredibly high because almost every dollar flows straight to the bottom line. Third, risk is transferred to the operator. If a mine has a cost overrun, the royalty company still gets their cut. Fourth, many royalty companies pay consistent monthly or quarterly dividends. And fifth, diversification. A single royalty company can hold dozens or even hundreds of different streams, spreading out the risk. But it is not all upside. First, commodity price sensitivity. If gold or oil prices crash, royalty revenue crashes right along with them. Second, depletion risk. Mines run out of ore. Wells run dry. Companies need to keep buying new royalties to replace the ones that fade out. Third, operator risk. If the company running the mine goes bankrupt, the royalty income can disappear overnight. And fourth, some royalty companies overpay for growth, taking on too much debt to acquire new streams, which can backfire badly if commodity prices fall. Now here is where a lot of investors get confused. Royalty stocks and REITs both feel like passive income plays where someone else does the operating. But they are fundamentally different in several important ways. A REIT owns physical real estate and collects rent. The asset does not get used up. A royalty company owns rights to a depleting resource, and that asset shrinks over time as a mine empties or a well dries up. REITs are legally required to distribute at least 90% of taxable income as dividends. Royalty companies have no such legal requirement, their payout policy is purely a management decision. Think of it this way, a REIT is like being a landlord. A royalty company is like being a silent partner in someone else's business. So what should you actually look for before buying a Canadian royalty stock? And which names on the TSX stand out right now? Let me walk you through both. Before buying any royalty stock, run through this 5-point checklist. 1. Diversification. The best royalty companies hold dozens or hundreds of streams so no single failure can sink the business. 2. A strong low-debt balance sheet. 3. A track record of consistent or growing dividends. 4. Exposure to high-quality low-cost operators, because a royalty is only as good as the company doing the digging. And 5. Reasonable valuation, since royalty stocks can get very expensive during commodity bull markets. Franco-Nevada is the original blue-chip royalty company and still the best. It holds over 400 royalty and streaming interests across gold, silver, oil, gas, and other commodities. It carries almost no debt, has never cut its dividend, and is widely considered the safest way to get gold exposure without taking on mining risk. If you only buy one royalty stock, many analysts would start here. Wheaton Precious Metals is the world's largest pure-play precious metals streaming company. Rather than taking a percentage of revenue, Wheaton locks in the right to buy gold and silver from its mining partners at a fixed low price, regardless of where the spot price goes. That structure gives Wheaton some of the highest profit margins in the entire royalty sector. When gold prices rise, Wheaton benefits enormously. Osisko Gold Royalties is the most Canadian-focused name in the gold royalty space, with around 180 royalty interests, approximately 95% tied to gold. Its flagship asset is a royalty on the Canadian Malartic mine in Quebec, one of the largest gold mines in Canada. For investors who want gold royalty exposure with a strong Canadian bias, Osisko is the natural pick. Freehold Royalties is Canada's leading oil and gas royalty company. It owns mineral rights across Western Canada and several U.S. basins including the Permian, Eagle Ford, and Bakken. Freehold pays a monthly dividend with a yield around 6%. Because it never operates wells itself, it has no capital expenditure burden and no direct exposure to rising operating costs. It is pure royalty income from energy production. And then there is Pizza Pizza Royalty, the most unique name on this list. It collects a royalty on total system-wide sales from every Pizza and Pizza 73 restaurant in Canada. Because same-store sales barely fluctuate year to year, its cash flow is some of the most predictable in the entire royalty universe. There is no commodity risk here. No gold price to worry about. No oil wells drying up. Just Canadians ordering pizza, and that has proven remarkably consistent. So here is the full picture. Franco-Nevada for maximum safety and diversification. Wheaton Precious Metals for the highest margins and precious metals leverage. Osisko Gold for a Canada-focused gold royalty with strong production. Freehold Royalties for monthly income from energy. And Pizza Pizza Royalty for the most predictable commodity-free cash flow of the group. Each of these companies gives you passive income without the operational headaches, which is the whole point of the royalty model. That is the royalty model in a nutshell. Not a risk-free way to get rich, commodity prices swing, resources deplete, and operators can fail. But for investors who want exposure to gold, oil, or even pizza sales without taking on the operating headaches, royalty stocks remain one of the most efficient passive income structures on the Canadian market. Drop a comment below with the royalty stock you want me to break down next. And if you are new here, subscribe, we cover the Canadian market every week.